In today's video, we'll be looking at fair value gap liquidity, FVG liquidity. And how do you take advantage of this and add it to improve your trading? So, first of all, you need to understand what fair value gap is. If you are coming from the smart money space, you will understand what fair value gap means. But if you are just joining the Forex market and you don't know what fair value gap is, it's simply when you have three candles, the first and the second candle wicks do not touch. In this case, for this bullish scenario here, the fair value gap is simply this rectangle line. Now, how do you mark this rectangle? You look at the wick of the first candle, you mark the top of that wick, and then the second candle, you do nothing about it, but the third candle is what we're looking at here. You mark it. So the distance between the third candle lower wick and the first candle upper wick is the fair value gap. All right. And typically, how it is being traded is that when market comes there, obviously we are looking for a bullish market. Okay. We are assuming that the direction bias is intact and everything. So what it simply means is that the moment price touches this level, you can start looking for a buy. Same thing with a bearish move. In this case, this is the first candle. The first candle lower wick, you are going to mark it because it's a bearish one now. Remember, in a bullish one, you are looking at the upper wick. In the bearish one, we're looking at the lower wick, first candle, and then the upper wick of the third candle. You are not interested in the middle candle, just the first and the third. All right. So if you want to continue this bearish movement, you simply wait for price to come in, and then you sell the moment price trade and tap the first level here, which is the third candle upper wick. You can sell, and then stop loss, maybe some stop loss will be placed just some pips below or above the fair value gap. Like in this case, you put it below the fair value gap. All right. Now, there's nothing wrong in trading fair value gap. But as you all know, in my channel, I talk about the opening price. Okay. So what I do is that I use the fair value gap as liquidity. Because a lot of traders will be looking at taking entry the moment price tap into this level. They are going to look for entries in those levels. Yeah. Stop loss below. All right. So what I would do is that I use the fair value gap as a liquidity. Okay. Like a trap. The market wants to trap those trading within here. So what I do is simply locate the opening price that is closer to the fair value gap. It may not be this particular opening price. It may be, if you look at your left, there might be another opening price that is closer to that. I use that as my entry. Instead of entering here, I'll simply wait for the market to take out the stop loss of those that place it below the opening price, and then I take this trade here. All right. So what I would expect the market to do is that market comes back down, tap in here, and then start moving in my direction. The same thing applies with a bearish move. Instead of me to engage within the fair value gap, I'll simply use that fair value gap as liquidity. All right. So what I do is I simply place my entry at the opening price, the continuation opening price. So this kind of opening price here is called the continuation opening price because it's the opening price that continues the direction of the previous candle. All right. So what I wait is for market to come, tap into my opening price, and then move after taking out whosoever is placing a stop loss just above the fair value gap. Now, this is one scenario where you can look at the fair value gap. So you can call this scenario 1. The other scenario is in this form. Yeah. So in this case here, it's not all the time you're going to see 3 bullish candles pushing upward. And not all the time you'll be seeing 3 bearish candles pushing downward. So sometimes you might have a bearish candle, then bullish, bullish. The main thing is that the wick, the first candle and the second candle wick do not touch, creating a fair value gap like so. All right. So what happens here is that most people trade using the fair value gap, and then they place a stop loss just below it. In this case, for a bullish move, they simply anticipate price to come back down and push higher. All right, putting their stop loss here. Then for a bearish move, they anticipate market to come trade in here and trade lower. Okay. And then they place a stop loss just above the fair value gap. For me, as I said in the first scenario, I simply use the fair value gap as a scenario. If by all means I feel the price should move from this level above, having using my confidence, I would rather take the trade above the fair value gap than within the fair value gap. I will give you exemptions to this. All right. So what I do is simply I'll wait for price to come to the reversal opening price, like so. So price come trade in here, and then I will engage the market and then trade to the upside. Same thing for the bearish side. Yeah. I'll wait for price to come up there and then move. What am I doing here? What I'm doing is simply using the fair value gap as liquidity, because a lot of traders trade it. So liquidity is simply a trap or a situation whereby you know that so many people will be taking trades around that area. So what you need to do is simply wait for some of them to be out. The wise one might simply put their stop loss way above that, endure the drawdown, and then market pushes. But most will simply follow the textbook instruction, few pips above the fair value gap, and in that case they will get out. And then once they get out, you enter and you see the market move precisely, giving you little or no drawdown. All right. Now there are some exemption. Exemption is the sense that if the fair value gap is too wide, maybe the gap between the first and the last is so wide. Let's assume this is a wicks, yeah. Okay, and then let me make this like this so that it appears to be very wide. So in this case, we have very wide fair value gap here. Now, when that occurs, when I see that the fair value gap is too wide, becoming a very big rectangle or square, what I will do is simply, once price comes in there, I'll simply look left for any opening price that is within this fair value gap. So in that note, if I have a fair value, an opening price somewhere there, if I look left, I'm going to show you on the chart, so don't worry. If I look at the left and I see an opening price, I'll simply pick that, and I will expect price to tap from there and then move. Same thing with this level, yeah. If it's too wide, I'll simply look for opening price within the fair value gap. There must be, that's the only way I can validate the fair value gap. There should be an opening price within it. If not, I'll simply wait for the fair value gap liquidity to be taken. So I'm going to show you with examples on the chart on gold. Let's simply look at gold daily. I'm not going to do a form of back testing. I'm just going to walk you through what I see. Okay. So in this case here, we have a bullish push. Now, all this in assumption that the market is bullish. I have a way of knowing the direction of the market. All right. I don't look at market structure for that. I simply know that the market is bullish based on some rules that I've put in place. And by the way, if you want to get a hands-on on the kind of way I trade, there's a link in the description for you to join the free mini course. From there, I'm going to walk you through a series of lectures. At the end of it all, you're going to understand what it takes to trade the opening price. All right. So looking at this first move here, for example, okay, in this case, we don't have a fair value gap. Okay, so I'm going to pass this. We are going to look at this here. There's a fair value gap here. As you can see, this is the first candle, this is the third candle. The high of the first candle, the low of the third candle, they didn't touch. So you can see this level. Let's assume I want to take an entry here based on the direction. Now, most people, what they do, they take entry at the beginning or even at the 50% level. All right. And then stop loss just below the fair value gap. Yeah. Like so. All right. Let's assume they put their stop loss here. What happens? Market will take them out unless they put their stop loss very far off. All right. Those ones will be saved. But in that case, the risk reward would not be compared to if you simply wait for the opening price to be tapped. We have two opening prices here. One, first entry, and this second entry. We still have another opening price here, third entry. The last one didn't catch. So we have three entries here. 1, 2, 3. Opening price that are below. Opening price that are below the fair value gap. So in this case, the fair value gap serves as liquidity, validating the strength of this opening price here. All right. So on that note, you can see market simply tap in there and then push to the upside. So that is one illustration there. Another illustration is, let's keep looking. In this case here, there are no fair value gap again. Where we have a fair value gap is this level here. Now, as you can see, in this case, the fair value gap is wide. So on that note, you simply look at a fair value gap closer to that level. And then you wait for price to tap it. Now, this fair value gap is huge. So I will not really wait for price to come into this level. I might go to the lower time frame and then get a better opening price within the 4 hour and then execute. But from the illustration I'm showing you, since this appears to be big, we have an opening price within that fair value gap. So I simply work with that. In this case, both parties will be successful. All right. But for me, my stop loss will not be below. My stop loss will somewhere be just some few pips below, because I know that this fair value gap have a way of working within this opening price have a way of working within the fair value gap. All right. Another one here, the exemptions. We're having so many exemptions here. Right here. All right. In this case is much. So what do? You can look at your left, the fair value opening price within. The closest opening price within that level is where market respected and then push. All right. Instead of waiting for this level here. Okay. Instead of waiting for this level. Same thing here. We have fair value gap here. The closest, we have this level here. You can see how sniper entry it gives to you. When price locates it, it moves. In this case, your stop loss in comparison with your profit target have a big RR. compared to entering here with the stop loss here. All right, so and so on and so forth. So in this case here, if you look at this, I don't consider this to be too big. Yeah. Now, not all the time the market will come to where you are. All right. In this case, price came low, push up to this level before eventually coming down. All right. But where are we still tapping it into the opening price to continue pushing upward? The other form of liquidity, which I will also be revealing within this YouTube channel. So if you are not subscribed, make sure you subscribe and then turn on your notification. I've cited an example here where in that case, if you are waiting for price to come here, you might miss the trade. All right. If you wait for price to come here, based on how I explained, you might miss the trade, and those that trade the fair value gap wins. But however, by the time you understand the concept of opening price, you won't be missing a trade because there are ways to catch these trades within the 4-hour time frame. So pushing forward, we have fair value gap here, but price did not come all the way down. In this case here, we have one here. This appears to be wide, but if you look at your left, there are no opening price, because as at when price came in here, it was on charted territory. There was nothing on the left. So in that case, I'll simply wait for this opening price to get tapped in. Yeah. And as you can see, we have a kind of sniper entry, little or no drawdown to push price to the upside. All right. Now, some of you, before this push down, these are all-time high, and I will not be recommending you just trade blindly within those areas. All right. Always wait for a premium before pushing. But for purpose of data analysis, if you take a trade here, at least the reversal, the continuation opening price, push price up to this level where you might have taken some of your profit before eventually coming down. Same thing here, but eventually it tap into an opening price and then push higher. Okay. Same thing here. In this case, it appears to be too wide and there are no opening price on the left. I'll simply wait for the opening price below the fair value gap. Let the fair value gap serve as liquidity. Price came, tap in there, and then we push higher. Now we are reversing, and then we have to simply wait. The market right now, for those of you watching this, the market right now is giving me a daily bearish signal. All right, but I'm only waiting if we can see rejection of this level. Then I will continue the bullish push. But if not, we should continue the bearish move until we have a confirmation of the daily bullish signal. So if you have any question, put it in the comment section. And if you want to join my community, join the newsletter and get enrolled within the free ETP program, Elite Traders Program mini course, where I'm going to walk you through how you can trade using the opening price strategy. Let me know how you feel in the comments. Au revoir.